I realize that people do not like having PowerPoint presentations read to them. However, there is so much valuable information here, and I'm so familiar with it, I feel I can make the points where they need to be made, while you can look at this as many times as you would like and hear the voiceover. This business of who will get your IRA, which is usually a person's largest asset unless they own a very, very large home, this is important because most people find out that they don't understand how the IRA works. Unbeknownst to most people, their portfolio could be a ticking time bomb. And our purpose is to give you information about your IRA and some potential problems that more than likely are unknown to you. This information is drawn from the following areas: the Pension Protection Act of 2006, the United States Tax Code, the Internal Revenue Code and regulations, the U.S. Treasury regulations. Now, this is to alert you of some 5-year-old legislation that you may be aware of. The Pension Protection Act of 2006. And if you are not, we will go over the relevant highlights. See, actually, this was a very broad reworking of the retirement asset rules, and it has some very useful strategies. However, it could have addressed other important issues. First, some of the good news. The Pension Protection Act of 2006 affords certain enhanced safeguards for the pensions of people they have with their company. The Pension Benefit Guaranty Corporation, which is actually similar to how the FDIC protects bank deposits, will now assure that another Enron does not occur and devastate a company's pension plan. This is certainly peace of mind and one less thing to worry about when thinking about your retirement. Here are some other useful news. People receiving Social Security pay a tax on that money if their income is above a certain amount. When they reach age 70 and a half years old, they are made to take a required minimum distribution from their IRA, and that minimum distribution added to their income can cause additional taxes to be paid on their Social Security. Most people, when they reach age 70 and a half, have genuinely earmarked that money to be given to their heirs or to a charity. However, there is more good news. A couple of Treasury regulations substantiated that the spousal rollover provision that allows for the untaxed transfer of an IRA to remain a safe harbor once it is inherited. It was also stipulated that IRAs left to a trust will not be included as taxable in the beneficiary's estate. These regulations and the numbers associated are strictly here for your tax professional who is giving you advice on your taxation. To be able to pinpoint where to look this up in the 70,000 pages of the U.S. Tax Code. You have done your homework for your accountant, so to speak. Well, you knew it was coming. Some not such good news. But in all of this legislation, with so many side issues attached, related to 401ks and 403bs, these are the plans that teachers have at school, nothing was done to apply uniformity and protection in the distribution wishes of a person with a normal IRA or a Roth IRA. This somehow slipped through the cracks in the floor. So, this potential problem still exists. The jeopardy is your IRA may well be the largest asset you have, but it may not end up in the hands of the person that you wanted to receive it. Of course, it is better that you are made aware of this while you are still alive, and you are able to address this issue. Your retirement assets are severely different than any other asset you own and are not fully understood by most people because you usually only retire once, so it is not something that you have any great deal of experience in doing, and the inheritance problems with your IRA will only surface at death. So you will never know about it because you only die once. You should take necessary steps to assure that your IRA ends up in the hands of the people that you wanted to have it. Unfortunately, and again, largely unbeknownst to you, there may be some custodial procedures in place that may thwart this from happening. We will explain some matters concerning IRAs and the custodians who hold them. You then can determine if you want to address these shortcomings that can impact your IRA and how and to whom it passes. The first difference we will mention between an IRA and other invested assets is that an IRA is a contract, and in being such, the death benefits pass only by contract and are governed by the four corners of the contract. The benefits do not pass by your will, no matter what your will states. Most people usually find this a little disturbing. They believe their will is the final document because it is called a final will and testament. The major difference is there exists an IRS form for the distribution of every one of your assets except an IRA. These distribution forms for your IRA come from the custodian that holds your IRA. They are all different. There is no law of uniformity that governs them. The custodian disposes the distribution sequence and rules according to its own process. A severely overlooked necessity. People have a 40-page will to carry out the distribution of their assets, but the distribution of their largest asset, their IRA, will be handled in less than 1 minute by some customer service representative who scribbles a few words on some mass-produced Xerox form. I'm showing my age by calling it Xerox, while eating their lunch. Not without our help in drafting a retirement asset directive. We're going to refer to it heretofore, for brevity, as a RAD, an RAD. That clearly delineates exactly how you want your distributions handled. Longer lifespans, untimely deaths, multiple marriages, and blended families can best be addressed by having a retirement asset directive. The RAD must not only be structured by someone extremely well versed in this rather specialized area, but it must also be accepted by the IRA custodian that accepts such documentation. Most custodians do not accept these documents. The reason is because they would have to effectively retool their entire data system, then educate their personnel, and involve a new account distribution system. They prefer that you never learn of any other potential problems with your IRA distributions. After all, when you die, if you desire to make a beneficiary designation for matters more complex than what is allowed on our standard forms, you may attach such designations, provided your accounts, both retirement and non-retirement, are at least $500,000. For the purpose of eligibility, your accounts and the spouse's accounts can be combined to meet the minimum balance requirements. End of their literature. Well, what does that mean? Essentially, if you have less than $500,000, then you really don't care what happens to your IRA, which is not important enough to your custodian. The following are examples of the type of problems that exist between IRA owners and their custodians. These are actual accounts of what have happened over the years. John is named the beneficiary of his mother's $700,000 IRA. One day, while they are both shopping, they were both tragically killed in a car accident. Well, Mom's estate went to John's wife, who the mother detested, inheriting that entire IRA. Do you know who will make that snap decision? Some customer service rep at the company that is holding your IRA. Now, this is how it all started. At the scene, a very qualified, valuable emergency medical technician, volunteer who responded, may have filled out the paperwork as to the time of death. These good people were not there when the accident happened, but they knew it happened around 11:50 p.m. So they put Mom's death at 11:50 p.m. and John's death at 11:51 p.m. The customer service rep, by contract, placed Mom's IRA in John's name, and it eventually goes to his estate, which is then inherited by his wife, which she detested, as we said before. The next example is a little complicated. However, we call it Jack or Jill. Tom has a $600,000 IRA and 2 children, Tom Jr. and Jill. He names them equal beneficiaries, and his grandsons, Jack and Bob, as contingent beneficiaries. Unfortunately, Tom Jr. predeceases his dad, Tom Sr. A while later, Tom Sr. passes on, and the question is, where does that share originally slated for Tom Jr. go? Well, there was a contingent beneficiary, Jack, but the relationship as Tom Jr.'s son was never stated on the simple contingent beneficiary form. The original form, when the IRA began, only asked for the contingent beneficiary's name. So once again, the customer service rep will determine whether Tom Jr.'s share goes to the contingent beneficiary, Jack, or it goes completely to Tom's sister Jill, as there was no retirement asset directive indicating exactly how he wanted this money to be handled in the event either of his children predeceased him or one of them predeceased the other. Remember, these are contracts, and the custodian is only responsible to follow the beneficiary designation. Once they have distributed the funds, they will not change their decision. Most judges will not undo a contract without overwhelming evidence that a mistake was made. Another example, Mary had a $1,200,000 IRA that was the result of rolling over her deceased husband's IRA of $965,000. The IRA of $965,000 into hers as allowable under the IRA code IRC 408 D3CI. Those numbers are not for you, they are there for your tax professional, who you should be getting help from. Now, she had no children, and her beneficiary was her nephew Mark. When Joan died, Mark was made to take the IRA all at once as a forced distribution, because the custodian's internal procedures did not allow for the beneficiary extended withdrawal option. The windfall was treated as ordinary income and taxed at the highest bracket, as was most of Mark's other income for that year. Now, her nephew is considered a Class D beneficiary and can only receive $500 tax-free in some states. Some of these examples might seem a little far-fetched, But here's one that should hit very close to home for most people. These are, like I said, actual examples of situations that have occurred in the past. Joan has a $360,000 IRA and named her 3 daughters as beneficiaries when she took the IRA out 30 years ago. In her will, she names her daughter, with whom she had lived, to receive an 80% share, and the other 2 daughters from out of state who never visited to receive 10% shares. When Joan died, the company followed their procedure of a per capita distribution, since the will did not supersede the contracts, and each daughter was sent 1/3 of the IRA value. A retirement asset directive would have honored Joan's wishes. So what happens next? First of all, a custodian will not and cannot get back a distribution. If there is a problem after the fact with the distribution, the custodian simply stands on the 4 corners of the contract. It will be up to the contesting parties to battle the matter out in court. That is, if a court will even entertain listening to it. Courts usually will not even review reversing a legal contract. There is no recourse whatsoever in all of these cases of the distribution of an IRA that may not have been done exactly as the owner had intended, and the custodian's liability is 0. Their responsibility does not include playing distribution detective. However, there is a significant difference. An IRA custodian disperses those monies according to the contract itself and works with the limited information on the original contract application that you gave them. But then again, you were never asked to supply any additional detailed information, were you? And maybe you did not even qualify under the $500,000 exemption. There is even a larger dilemma. The husband reasons out that his wife would someday enter a nursing home, and he did not want the IRA he saved exposed to Medicaid confiscation, so he names his son as the beneficiary. He is a good son and will certainly watch out for his mother if need be. As soon as the father dies, the son takes the IRA money and buys a mansion for his new wife, who the father despised, and her 4 children from 2 previous marriages. 2 months after the closing on a new home, the son's wife files for divorce. The son ends up paying the mortgage, while his wife, who is soon to be an ex for the 3rd time, lives in a house bought with his dad's IRA money. Is there a method to avoid all of this? Yes. A simple retirement asset directive. Now, you may find this next example amusing, but Brinker the Thinker is what we call it. John Brinker, who had considerable assets, had already heard the story of leaving an IRA to a wife and having it decimated by estate taxes and also exposing it to Medicaid. And while some often married woman enamored his son, she would never get her hands on his IRA. he would make his $750,000 IRA payable to his estate. And that would be that. Probate. Everyone understands about it. Everyone heard horror stories about it. Some true, some not. Some exaggerated, some mitigated. However, the facts are putting any assets in an estate is not the most prudent way, because it must then be probated, and all estates in probate are subject to access of creditors. John's old business partner from a failed venture 10 years prior won a judgment against the estate and was awarded the entire IRA. There was another solution. Brinker could have had a well-crafted retirement asset directive. They would have made his IRA payable to a trust that would be immune from creditors. The IRA would continue to grow tax-deferred as it would be a separate entity. It would not be bound by any distribution schedule, such as the 70-and-a-half-year-old rule, and could be dispersed in any fashion that the trustee he had named saw fit, or according to a schedule that Brinker himself put into the trust. Imagine that. He could actually be controlling his money from beyond the grave. Now, what you have just seen are some tragic consequences. Every one of these situations occurred because people did not know the internal rules of their IRA custodian, or because their custodian did not accept the retirement asset directives, so they wouldn't have to change any of their internal policies. But every one of these situations was avoidable by having a retirement asset directive in place with the right custodian. Do you really want the customer service rep determining who your heirs will be? There is a simple assurance that this does not happen to you. We have the expertise of document generation in this field, and we have the IRA custodians that honor these instruments. And you have the choice of what to do. It is really a simple decision. The IRA owner that wants to guarantee that their post-death wishes for distribution are carried out exactly must have a properly crafted retirement asset directive that exceeds the severely limited custodial forms, policies, and procedure. We draft retirement asset directives with no charge for all of our clients. The process is very simple. You make a lateral transfer from your IRA custodian to our IRA custodian. It is then housed in a safe harbor annuity, which is linked to either the S&P 500 or to a fixed 3% guarantee annuity, much like a CD, only with 2 or 3 times the return. Now, the S&P 500 is much less volatile than the Dow Jones Industrial Average of 30 stocks. While a 3% guarantee might not seem like setting the world on fire, it certainly beats drowning in a pool of poor investment advice from brokers and investment advisors who couldn't see the crash coming in time to get you out, but can accurately predict a recovery. They've been predicting the recovery for 5 years. Now for some great news. Your principal is guaranteed. You can never experience a loss like you could in the stock market. Whether you choose an annuity that is indexed to the S&P, or you choose any annuity or the guaranteed products, The annuity can never be less than the initial amount you place in it. On the anniversary date, any gains that you have accumulated will be added to the base, and they will become the new basis for the guaranteed amount. If the market should collapse later on, you still get whatever you started with, plus whatever gains you locked in on the anniversary date. It can go higher than 3% on our guaranteed product, but it cannot go less than 3%. And actually, it's 3.25% starting this year. If the market stabilizes and you're comfortable, you can always put money back into the market while maintaining an unshakable base. Simply put, you have now exchanged the maybes of a gain for the guarantees of our advice. Upon receipt of the transferred IRA, we will priority mail you the necessary forms to establish your retirement asset directive. You complete these forms and return them in the priority envelope we'll provide you. We create your retirement asset directive and send it back to you priority mail for your signature. You then return the signed original document to us, and our custodian files this document. We use the companies with the absolute best track records to protect your investment and make sure that you never have less money in your account than your initial deposit. I hope you find that interesting. Most people are fascinated by those stories and how IRAs and custodians really work. See, we feel that IRAs are actually a savings plan for the government because you have to pay so much of what you gained back to them, and it can impact any additional income you have. Some people are working past age 70, and quite frankly, because of their minimum required distribution for IRAs, they actually have to pay quite a bit more in taxes than they can. The only way you can avoid that is by placing some of that IRA money into a trust. You need to decide who will get your IRA. Don't allow some service rep to make sure somebody else gets it. Take charge.